Hi, this is Mike. I've had some questions about how futures and stocks are different, and so I thought I'd address that in a quick video right here. The first thing I want to point out to people is that futures and stocks are different, but in a lot of ways they are more similar than people think. The first way that they're more similar, the price action matters for both futures and stocks. What we care about is how the prices move. We care about if the stock goes up, that we're long. If the stock goes down, that we're short. Same thing in the futures market. We want to be long when the futures markets are going up, and we want to be short when they're going down. If we're trading ExxonMobil and the price of ExxonMobil is going up, we want to be long ExxonMobil no matter what. If the price of crude oil futures is going up, we want to be long crude oil futures. So the goal of trading is to make money. The vehicle, the market that we actually choose to go out and make the money in, isn't as important as being on the right side of the market. And so this is one of the ways that price action is very important for both futures and stocks. Another way that futures and stocks are similar is the risk of loss. Trading is risky. Stocks and futures are both risky. Do not underestimate the risk. You can trade anything you want out there. Doesn't matter what you trade, you are facing risk. Do not overtrade, trade less than you think you need to. People who thought that stocks were very safe were proven horribly wrong in 2001, and the stock market really has never recovered. It's over 10 years now that people have been losing money in the stock market. The stock market's at similar levels to where it was in 1997. After the 2001 crash in the stock market, the stock prices never recovered. So people, they moved into housing. And how did that go? We know the housing prices go down too. Anything you buy that's a major purchase can go down in value and is risky. Futures are risky too. Do not underestimate how risky futures are. You can lose money trading futures. You can lose all of your money trading futures. You should be very, very careful with your money no matter what you trade. Do not underestimate risk in stocks or in futures. They are both very risky. So that's another way that they're similar. Very risky. Now here's how they're different, stocks and futures. Stocks. The prices and the quantities are easy to understand. The price times the number of shares equals the cost that you pay for stocks. So we know that it's very easy to understand how much it's going to cost you to trade stocks. You just multiply the price by the number of shares. It costs you that many dollars. Now, there are some differences with futures here. Stocks, you do not get leverage. With futures, you do get leverage. What leverage means is that $1 controls more than $1 worth of assets. This was done in the futures markets to make it easier for farmers and natural hedgers to hedge their prices or their crops without spending every dollar in their bank account and all their money in their friends' bank accounts too. And as a result, there's a lot of leverage in futures markets. It makes it very risky. Be very careful. My solution is trade very small. You should always trade much smaller than you think in the futures market. Second way that futures are different, the multiplier. The price multiplier in futures markets is nearly never 1. In stocks, it's 1. So you know if you multiply the price that you pay times the number of shares, you'll get the cost that it costs you. For futures markets, this is not always the case. So we know, for example, that the futures multiplier is different. For example, in the bonds here, T-bond, the futures multiplier is 1,000. For every 1 point that it moves up here from 141 to 142, it will be $1,000. For gold, it's $100. To move from 1760 to 1761 will be a $100 gain or loss. Every tenth down here is worth then $10. So today, gold is down $31. That means that 31 times 100 equals $3,100 in losses for people that were long gold, or $3,100 in gains for people that were short gold. You can see why I tell people to trade small and use the mini contracts, because these things can move around quite a lot. The crude oil, the multiplier is $1,000 per point. So to move from $97 a barrel up to $98 a barrel, it's $1,000. Each of these little points here from 75 to 76 then would be worth $10. The multiplier in the mini micro corn, I should say, is only $10. So to move from 6.45 to 6.46 here, it's only $10. You can see corn lost 10 cents today, so that would be a total of a $100 move. You can see it's much more affordable, these smaller contracts. Same with the soybeans, $10 multiplier there for the mini or micro contracts. So to move from $11.67, it lost 18 cents today total. That's $180. You can see it's much more affordable for people. So I definitely recommend trading the micro contracts for most of the futures here. It's more affordable for most people. If you have a larger account, let me know. We can create a special program for you. The next way that futures are different than stocks. Futures expire. When you buy a stock, you get a stock in your account, and as long as you want, you can keep it in there. It will not get taken out of your account unless you decide to close your account or sell it. This is not the case with futures. Futures have an expiration. They only last until a certain day. What a futures contract is a contract for future delivery of something. So for corn, you would buy a corn futures contract. You're getting a contract to be delivered corn at some point in time in the future. This would be like ordering your groceries from a grocery store to be delivered next week, or possibly ordering a sod for your yard and telling them you don't want it until 2 Saturdays from today. You order something today, and then in the future it gets delivered to you. This is exactly what a futures contract is. It's a standardized contract. It says, I want 5,000 bushels of corn. Please deliver them to me on December 17th, 2011. And it's a standardized contract. Everyone knows exactly what the contract holds, so it can be traded very freely because you know exactly what that contract is, and every contract is the same. I've never been delivered on a futures contract after making over 100,000 futures trades. I know in my CTA, where we traded many hundreds of thousands of trades a day, we were only delivered on one contract one time. It very rarely happens. Most people never take delivery. Just to recap real quick, the way that futures contracts are similar to stocks is the price action is what matters. You want to make money, and whether you're trading stocks or futures. You want to avoid losing money, whether you're trading stocks and futures. And the way that money gets into your account or gets taken out of your account is through the price action. The other way that they're similar, the risk of loss. Any type of trading is risky. Do not underestimate your risk. Any trade you ever make in your life is risky, and you can lose money. Please be careful. The way that they're different, stocks are a bit easier to understand. They're a very common thing. Futures have some different qualities about them. There's some leverage. The multiplier is different than one for every futures contract, and they expire. So those are the differences between stocks and futures. Thanks for watching this video here, and I look forward to talking with you in the future.